Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Nathan Scripps of Common Sense Growth. Nathan, thank you for joining us.
I'm looking forward to the talk.
Well, great. Can you tell us about your background before you got into investing in early stage? What did you do before this that led you into this area?
Sure. So I started out as a mechanical engineer from Georgia Tech. I was working for General Electric and not exactly loving it. So I traded coast and career in 2005 to join the startup world. I've been really fortunate to help scale 2 startups through acquisition. Both of them have been in automotive, and both times I joined as employee number 20 or so. And oddly enough, both of them got acquired in under 2 years from my start date. So it was really rapid growth, a lot of fun. And I stayed at both of them for a couple of years after acquisition as well. So I got a really good sense of what it takes to kind of integrate into a parent company and then in the first experience. And then I also got a chance to integrate multiple startups into a single suite of services in the second experience. And that, like I said, that was both automotive. The first was called Jumpstart Automotive Media. They were acquired by Hachette Philippaki, later sold on to Hearst. And the second was called Driver Side. It was a SaaS platform that was acquired by Advanced Auto Parts.
Well, great. Tell us how you got into Common Sense Growth and how you got into this area.
Sure. If you find me on LinkedIn, you'll know that I talk about people a lot. And one of my big drivers in all of my experience over the last 10, 12, 15 years has been people and culture of the business are really what drives results. And I am fortunate to work with Jad Dunning, who was the co-founder of Driver Side, my boss for a long time, great guy. And he came over to Common Sense Media and really helped develop the initial thesis and begin Common Sense Growth as a for-profit subsidiary of the nonprofit Common Sense Media, which is the largest and leading nonprofit for school-age kids and their families in the country. So from talking to him, and he was there for quite a time before I joined, the pace of the challenge, the problems that he was facing and kind of like trying to tackle on a daily basis, and the people around him are really what led me to be excited about joining. And the timing was actually incredibly lucky. I also recently became a father, so the idea of working in a nonprofit governed environment that focuses on improving the lives of kids as we move into this more technologically and social media oriented culture is something that's really personally fascinating to me and extraordinarily relevant in a variety of ways.
So you've done investing in this sector, and we have quite an audience of investors who are always looking to learn how to invest for the first time or into new areas. What's your advice for people that are investing in startups, especially in the sector you're in?
Well, in general, I say you got to invest in things you're excited about, especially in the early stage, since you don't really know how things are going to pan out. You need to enjoy the headaches, right? You have to want to clear the hurdles you don't see coming. And that really comes from, I think, a personal passion. So if you don't connect with the founding team personally, or if you don't connect with the underlying mission of the company at a personal level, the earlier the stage, the harder it'll be to invest in. The later stage stuff where it's like growth stage investing or something that's pre-IPO, that becomes a numbers game, and it's a lot about do you have a specific skill set that you understand very well, or do you have a specific niche that you can apply towards that business to help them top out? But especially early, you gotta love it. You really do.
Well, the kids media industry is an area I'm not that familiar with. Can you tell us about how that industry is evolving and where is it going?
Absolutely. So as Common Sense Growth, we invest in, broadly speaking, anything that helps kids and families thrive in the 21st century. Now, that tends to turn into kids media and educational technology. And I think there are 2 big factors that are really fascinating right now that are making this industry evolve in kind of a different way. First, you got to look at privacy issues, addiction problems, and other negative externalities of social media that are coming into a spotlight at a national and global level. So that spotlight is creating a wave of interest in transparency, privacy rights, best practice considerations, and parents are really looking for these things to improve the health, safety, and well-being of the kids in their lives. So all of these things have been championed by Common Sense for years, which makes our involvement at Common Sense Growth, investing in these areas, very unique. So that's the first issue, is that privacy, addiction, and other negative externalities have been on the rise in the public eye. So there's a lot of focus on the industry. Second, there's a new generation of parents entering the market right now. The millennial parent audience is brand new. It's massive in terms of adopting technology and using technology in their daily lives. And then while we see them entering the market, from my vantage point, we're also seeing millennial parent founders entering the market. They are working, generally speaking, especially over here in the San Francisco area. They're working at a tech company. They have their first kid. They look around for resources and think to themselves, this is not great. It's not what I expect. So I am just going to use my skill set and build a better solution. So those parentpreneurs are really coming up right now in a variety of ways and in a variety of areas. And they're creating services to solve their own problems, which I think is a fantastic motivation for an early stage founding team, is that they had the problem first. They were their own use case. They found other people similar to them. And especially when you're considering the millennial parent market, that market itself is massive. And as somebody who had a kid literally one day shy of 3 months ago, I'm in that market as well. So it gives me a unique perspective as I talk to all these founders and look at the market.
So from an investor's perspective, what should they be looking for in this sector as far as how is the landscape changing based on the dynamics you just listed? What is that impact on the investment side?
Sure. So as those two factors keep impacting what happens, right? The increase of focus on privacy, addiction, and other negative problems, the rise of the millennial parent as both workforce, founder, and marketplace. I think we're going to see a new type of media creation that is digital first. Distribution channels are going to be kid first, right? Like the internet as a whole was built for adults, not really for kids. And I think we're going to start seeing distribution channels and advertising models come out that are built kid first, because we're monetizing the internet and we're monetizing the addictive behavior for adults, and kids are getting caught up in the same net. So I think we're actually rebuilding the infrastructure layer. And how I think that's a way that I've described it, I should say, to other people, is that when you see really big lightning rod companies spend a lot of ad dollars, you know that the space is important and that a bunch of software startups are probably going to move there. So when you see Apple's commercials for the iPad focus on elementary school kids making a presentation, they're going about their day, they're carrying the iPad around, they're taking pictures, and then they present the presentation in class. Technology in the classroom is a big deal. Google's Chromebooks are already there. They have Google Classroom software is already there. So if Apple and Google are both focused on the classroom and the school-age kid population, you know that it's like the Wild West in the software world to do the exact same. But it's a very different market since it's all kids. You have to be very mindful of privacy. The internet, technically, in my opinion, wasn't built for kid users. It was built for adults. All the rules were made for adults. So Common Sense as an organization has taken a lead in helping to redefine some of those rules. And then a lot of the companies we look at and a lot of the companies that are coming out are helping to redefine what that internet experience is supposed to be for those kids.
So you invest in this sector. What is your investment thesis at this point? What do you think is going to be the winning formula for it?
Well, as the for-profit arm of Common Sense, everything we consider has to be fully mission aligned with our parent nonprofit. As such, I've said before that we are building and investing in products and services that help families thrive in the 21st century. That is a very generic sounding thesis, right? It's not critically laser focused. And that's okay, because we're redefining a lot of things in the market. And what we have to look for are things that uniquely fit into our mission alignment, things where the Common Sense brand, assets, and audience really work, and then products and services that we believe would serve our existing audience well, which happens to be quite large and nice. So it's a little different than other typical investment houses.
And what for startups out there who are thinking of approaching you, what's your criteria? What would you tell them to say, yeah, that's a good fit, or no, that's not for what you want to do?
First, I'll tell you, just go to commonsense.org and cruise around. Like if you're going for the consumer market, look at our ratings and reviews and try to understand what we're presenting to our audience. If you're going for the school market, look at our education ratings and reviews and read up some of our content there and try to understand like our philosophical approach to both. And we also have an advocacy arm. So if you are one of the rare few and very valuable companies looking at improving the transparency and democratization of the internet and of access to information in general, we would love to talk to you as well. So just go take a look at commonsense.org. We have 3 very different focuses there, and we would love to hear about all of them. Something to really consider, though, is how our brand might play into you and how you might play into our brand. Because when we look at investing, we consider ourselves a strategic follow-on investor. We're not pricing around, we're not leading around, but our brand, assets, audience, and yes, check should add a lot of value to you. And I would typically say they add value in that order. Our brand, our assets, and our audience. And yes, our check will add value to what we can do for you.
We see a lot of startups in this space. What do you think is the main challenge these startups face in trying to solve these problems that you just brought up a moment ago? Where are the challenges that they have to overcome?
Sure. I think that there are a diversity of opportunities. And I think that's actually the real challenge, is that lots of startups, especially early stage, are trying to get that first dollar. They're trying to make that money. And when you look at schools as an example, it's a challenging marketplace to sell into. So if you have a B2B SaaS platform, it's very tempting to just pivot really quickly and sell to a different for-profit audience. So that's the first challenge, I think, is that by endemically going after schools, you know that you're up against a higher hurdle than if you just went after a typical for-profit B2B model. Same thing if you go after children. When you go to sell into the children's market, there are a lot of different rules and regulations and privacy concerns that are different. So we just have challenges in our space that are uniquely different than the typical going out to other people. And I can give you some specific examples of that if you like, or I can keep talking more generally about the space.
No, I think that's good. If you had a few examples, I think I'd be interested to hear more about those.
Sure. So as I mentioned earlier, when you see people like Apple and Google going after the classroom, you know that there's going to be a lot of other software companies kind of around that ecosystem. One of the companies we talked to recently shared a really interesting fact. On average, school districts across the country access 548 different software tools per month in order to deliver education to their children. So that massive number creates a huge management problem for IT administrators. It creates a huge credentialing problem for teachers that are kind of touching a lot of different platforms. Huge privacy concerns when you have that many different players kind of funneling down into such a narrow space as the classroom at any given level. That fragmentation alone is a challenge. There are already multiple platform as a service companies in the ed tech space. So when you've gone beyond software as a service and you take one step up to platform as a service, you understand the fragmentation we're dealing with. And that is a reality of the space. So that's a very specific example of where it's a crowded marketplace. A lot of players are in there. There isn't necessarily a clear leader in every single niche. And schools are trying to take advantage of as many of these platforms as possible, particularly all the ones that are using a freemium model to kind of get their foot in the door and maybe sell upward.
So on the investor side, they're always trying to mitigate risks. What are the key risks they should be looking at in investing in this space?
Fantastic question, and something that we really consider all the time. Me personally, I think the biggest risk is when early stage companies are struggling to maintain mission alignment. If delivering a quality product or service or online experience to children or the school or parents, if that is not core to the mission, if it's a marketing layer on top of a general set of tools, then it's just not going to work. So you really need to understand, the biggest risk I see is how you can understand at an innate level, is this mission or is this marketing? And that's what I think is the biggest risk, is that there are a lot of people who put a marketing layer on top of a nice set of tools because they think it'll be good to go into our particular area of the market.
Well, that's great. So where do you see the immediate opportunities for investors to pursue? Which sectors do you think are the ones that are going to be the most fruitful?
Well, I'll use this to kind of say, as we approach the midterm election season and when we have politics and kind of in the news all day, every day, as we have seen as of late. I really hope to see more people look to clean up the media landscape in a variety of ways. I think that opportunity is rich. As I mentioned earlier in the talk, the internet at large was built for adults, and the advertising industry at large has monetized our attention. And that means that the way the media is displayed in terms of the idea of fake news, in terms of the idea of social media, in terms of am I seeing what's chronologically relevant, or am I seeing what is, from an engagement standpoint, creating more clicks? So those things, all those infrastructure layers of the internet, I think are being observed and analyzed, and in some instances replaced. And I would love to see kind of a more transparent, more personally viable media experience in general.
Well, that's great. Well, in the last few minutes we have here today, what else should we cover that we haven't?
First, I would just like to say that, that there are a lot of startups around the Bay Area, and there's a lot of startups popping up in Austin and New York and Atlanta, and there's all these startup hubs, right? And you go into them and you're like, you see the energy, they got the t-shirt, and on the wall they have their mission or their values or their key positioning statement. And it's written up there in vinyl letters. And what I really want to point out is that, especially while investing, and more importantly, while you're applying for a job or considering what to do next in your career, really make sure that the mission is more than vinyl deep, that the values have real ownership at the founder and other level. And what I've personally done for that, what I would hope that other people want to do the same, is what I call MAP metrics. That's mission aligned performance metrics. So if you see a mission statement or a value proposition or a list of 10 values that are important to a company, grab a hold of the last all hands report. Get a hold of if you can get access to the investor statement or the board notes. What metrics are they presenting? And how do those foot back to that mission statement or those values? Because if you can't map those two things together, that means that the daily operation and management of the business is not truly aligned with the mission, vision, and values. So that's what I would really kind of give as my last bit of advice if I could.
Well, that's good advice. I think everyone should take that to heart, and I certainly think that's wise words. So how best for the audience to get back in touch with you?
Check me out on LinkedIn. So I'm just Nathan Scripps on LinkedIn. I'm the one who works at Common Sense Growth. Also, if you want to drop me a line, I'm in Scripps at commonsensegrowth.com. And if you're curious about a way to kind of better connect small groups around small conversations or activities, we recently launched a product called Common Sense Connect. So I'd encourage you to go to commonsenseconnect.com and maybe start up a group. I'll be happy to help you out with that one too.
Very good. We'll put those in the show notes so people can follow along. Appreciate your taking time today and hope to have you back for a follow-up in the near future. And with that, we'll go ahead and close it.
Thank you so much, Hall. I appreciate the time.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.